Hi, this is Jorge, the official. Uh, this is a chat here live from Singapore on Wednesday, the third day of APPEC. It's nearly 5:30 p.m. and it's a dark and gloomy day. You don't see a lot of blue in the background. In fact, it may rain, which suits the mood here. So I'm with two very good friends here. Harry, with whom I work, and Vandana, with whom I used to work. She now has a consulting firm, Vanda Insights, and I really appreciate that you're joining us to participate in this discussion. And hopefully another friend of mine joins us later. But if he doesn't, we'll just do it among the three of us. The purpose of this discussion is to go over what has happened this week. It has been a hell of a week. And as I was indicating earlier, if you were long, you are suffering. You lost your money. Hopefully you haven't lost your job, even though we already heard of some people who lost their jobs. That's the way it goes. But the market corrected massively. And in our opinion, as the officials, we have been bearish for months actually, because all the macros have been incredibly negative about the contraction in Europe, in Germany in particular, the worsening indicators coming out of China, and the only positive sign we see, besides the US that is a little bit stable to a little bit of growth, is India. So I was really looking forward to having Vandana in this chat, so you tell us what is happening there with oil and the economy in particular.
Yeah, thanks, Jorge. So as Vanda Insights, we provide macro analysis on the oil markets. And certainly being in this part of the world, I do look very closely at what's happening in China as well as in India from a macroeconomic perspective as well as from the oil demand perspective. Now, again, as you mentioned, indeed, Indian economy has been doing very well. If you look at Indian oil demand growth, 22 was a recovery year, 23 continued to be a recovery year. And a lot of people were expecting Indian demand growth to then sort of start moderating to pre-COVID levels, but it's growing at around 5% year on year this year as well. Now, what does that mean? And I like to put that in perspective because I think a lot of the oil watchers, especially in other parts of the world, miss out on this because we talk about China and India in the same breath. And some tend to say that, if China is slowing down, India will come up, it will be the new engine of growth. So why we need to put this in perspective is India consumes a third of what China consumes in oil.
Okay, I wanted to stop you there for a second, if you don't mind, because I'm one of those that thinks that if China falls off, India picks it up. But you just highlighted, it's only a third of the demand.
Yes, so what does this mean? If India is growing at 5% year on year, in absolute terms, it's adding about 250,000 barrels per day of absolute oil demand, which is not the same as China growing at 5% even, let alone high single digits, which would add 750,000 barrels per day, right? So there's a big difference in scale here, and I think that's important to bear in mind. So I would bring that back to China to say that as a result, if China is slowing, it is a serious matter for the oil markets. Frankly, I look at Southeast Asia as well, and those economies are doing it well too. To some extent, a drag from the Chinese slowdown, but independently they're doing all right. But again, none of them, even put together as Southeast Asia, is going to match the kind of demand growth that China contributed to the globe through the 90s and the noughties.
And what I wanted is your overall views of APPEC and how you fit in what you heard here about the slowdown, the oil price crash, and the global economic indicators. What are your key takeaways?
I think there's been a lot of doom and gloom. The first couple of days of OPEC, you've seen the trade houses coming out calling for $60 oil. I think there's a true recognition in terms of China's oil demand, at least in its gasoline segment, that there is something afoot. Gasoline demand in China has certainly peaked, and we're having a sudden awakening to the fact that there has been very aggressive transition, substitution into EVs from a traditional internal combustion engine type vehicle. And so that, I think, has caught a lot of people by surprise. It's sort of China's gasoline demand now and is in the rearview mirror. As far as the positive side, I'd say, look, petrochemicals, there's going to be a need for feedstock demand, whether it's propane or naphtha. Yes, the sector in China is in overcapacity. They're going to run it anyway. So there is still a base load there of demand. But having said that, top on the macro factors, top on the poor liquidity, top on the max short positioning, and the clear jitteriness in markets, as we witnessed yesterday on Tuesday, then where is the oil price going to go? And that's where I think we have a spectrum that's quite wide in terms of where people think it's going. Personally, I'm a mid-70s man. You're a lot more bearish than me.
I am a lot more bearish because I was also thinking about the petrochemical market. And in my early days, in one of my first reporting jobs, I was a petrochemical reporter. And what I learned very quickly is I was with a senior guy and we were in an office and he said, look around you. And I said, yeah, what? And he said, look, the floor is petrochemicals, the walls are petrochemicals, the ceiling is petrochemical, the clothing is petrochemical, the glasses are petrochemicals, everything is petrochemical. Which means then that if the construction industry falls out of bed, as it clearly did in the demand for these petrochemicals that are in rugs, in windows, in coatings, in furniture, in anything you can imagine, what's going to happen to it?
All true. However, it doesn't preclude them continuing to operate, exporting that surplus to European markets, and killing the petrochemical industry elsewhere in the world.
I think there's a slight problem there. I think when it comes to Chinese petrochemical demand, we should look at domestic consumption and we should look at the export potential. Now we know that Chinese export markets in general for goods, from the smallest of goods to cars, has been shrinking because European appetite for Chinese goods, because European economy is not doing that well. So I would actually argue that is there going to be robust enough demand for Chinese exports that use the petrochemicals that China is producing? In fact, I think some of the things that I've been hearing at APPEC is that Chinese petrochemical producers might also not run flat out. They might rein in their production as well.
That's interesting. You come at it from the demand side angle, whereas I'm looking at it from the supply push angle. A little bit like how European refiners used to push out their excess gasoline supply, either to West African markets or to the US, just to be able to tighten things at home. So maybe somewhere in between, but it just seems to me with all this new petrochemical capacity tied to actually refining capacity, what has been newly built, they're going to run it, and the overall operating levels of the industry as a whole may come down. But personally, I think it's sort of the bright light in the Chinese demand picture where everything else is dark.
So let me marry these two views here together. If we have brand new petrochemical plants in China, they will be efficient. And they'll be more efficient than the European ones that have no demand. So what you're telling me is that the European industry will continue to go down, will continue to be shut down, and demand for naphtha or gas in Europe is good, isn't it?
Well, there's a possibility, but we have to see trade relations, how they evolve. Could be just like the auto industry. Again, big question mark.
Now, I would like to continue this conversation, perhaps a little bit more focused on the Chinese side, if you don't mind. Now, as I have indicated, I would like to have more of a Chinese point of view or Southeast Asian point of view. And I'm inviting a dear friend of mine, Alex from Hendon. Please come in and join us.
Oh, sure.
Hi, Alex.
Hi, guys.
Join
Thanks
you.
for having me. It was meant to be a Bakute session, but I think it turned out to be a chat session now.
We were going to go for local dinner, and I decided to ambush him because I know he is a good technical trader with a lot of experience in futures markets, which he marries with his experience in the local economies. And as it happens, he has been in China in the past month. I was there last week and I didn't like the slowdown I saw, but I was only in Shanghai, and I know you have been in many other places. So if you could provide us with a broader view of what you see in China, that would be great, Alex.
I guess it's like, firstly, a disclaimer. I was there on a visit because I haven't been there for a while. right? Post-COVID. I mean, I do frequent China in the past, the main refining areas of China and all. So the last month was more of like checking out what's going on in China actually. So if you look at China as a whole, there have been a lot of media, talking about China, talking about how bad the economy is, being trashed quarters after quarters, kind of stuff. But the reality is the consumer side of things, not really the luxury, but generally the middle class, the lower class, they're pretty vibrant. I see a very different picture, of China. And it's like recent reports, as you can see, there are green shoots coming out from China, right? Even their Caixin, their PPI, etc., has gone above 50 points, etc. So, but the market is it's very different in a sense that they have this terminology called expectations. So when you do not meet the expectations of a 52 point, 53 point, and you have a 51 point, the market just sort of, China is in a very bad shape. Right?
If I may stop you for a second, there are two things that really impacted me. One was the absence of cranes in residential neighborhoods. It seems that construction is dead. There were some cranes in infrastructure projects, so they continue. High-speed rails, big roads. I mean, it's really, really impressive. But from a residential point of view, it's that in what I saw in the Shanghai and Nanjing area. The other was the penetration of the electrical vehicles, so massive. So I don't know if you have a sense of the real estate market there, but we were told it has fallen easily 30%.
I guess it's like if you have to look at the real estate market, you have to take a step back and think about what happened, in the past 20, 30 years of China's expansion, right? They have grown significantly, and a lot of Chinese people indulge. It's like buying property, to form a nest egg and thinking that the economy will boom over time consistently. But the reality is some of them actually over leverage and all. So hence, now under the leadership of the new Chinese party, under Xi Jinping, he believes in residential property is for stay, right? It's like common prosperity. He's got a different viewpoint, and hence I think they have a different kind of priorities now, right? Infrastructure development is definitely key. EV, climate related kind of programs and all, they have been active. You look at the EV space, almost every single shopping mall you see EV showroom, everything, right? Competitive, it's like, well, in Singapore you probably spend a $200,000 car, but over in China it's probably less than 30,000 for that matter, right?
Definitely.
So the reality is that they are very competitive. As what Elon Musk say, if China brings in the EVs and all into America, they'll bankrupt the entire automobile industry in the US. So they are forced to be reckoned with. The EV has been doing well in the sense that they are a market leader in that space.
Thank you, Alex. And now I wanted to slide into the next topic. The market has been correcting down on stocks. And every time it corrects down, by definition, it has a dead cat bounce. So in the very short term, and I mean a day or two, it's a dead cat bounce. And then after that, we are going into the swinging 60s again. And then we'll have another dead cat bounce until we start exploring the bottom of the 60s.
How many cats do we have?
9 lives.
Nine lives, right?
9 lives.
Yeah.
It's the same cat.
Just check.
Yeah. And then the issue is whether OPEC, the UAE, the rich OPEC members need cash to balance their books. And in my kind of high-level economic view of their balances, they need cash. So they'll be under pressure to sell barrels. And that means we may explore the low 60s, if not lower. But anyway, great to have you guys here. Thank you very much.
Thank you for having me.
And we'll see what market does.
65 base, probably.